c'est fini. Good afternoon, ladies and gentlemen. I am very pleased to welcome you all to our conference on accounting meets valuation. This conference brings financial reporting experts and valuation experts together. They will bring their different perspectives to discuss why and when fair value enhance financial reporting. It is a great to see that so many of you are interested in this topic. Inscriptions were so numerous that we could not have the event in our premises. Let me first say a few words about EFRAG. I trust and hope that many of you are already familiar with EFRAG and our activities. EFRAG's mission is to serve the European public interest by developing and promoting European views in the field of financial reporting. EFRAG works to ensure that the European views are properly considered in the IASB standard setting process and in related international debates. EFRAG has three streams of activities. Firstly, our research work in which we try to provide through leadership designed to encourage international debate, influence the AISB agenda and contribute to the AISB's project from a European perspective. Secondly, EFRAG provides the European views in the IASB standard setting process, starting from early stage to the post-implementation review. This is to ensure that the resulting standards are suitable for Europe. Then, when the IASB has issued the final or revised standard or interpretation, EFRAG's third activity is to advise the European Commission on whether this meets the criteria for endorsement for use in Europe. This includes whether endorsement will be conducive to the European public good. EFRAG's public-private sector model is representative of public and private stakeholders with an interest in financial reporting, as reflected in our funding and our organization structure. EFRAG interacts with European and national organizations, political, supervisory and regulatory authorities, representatives of preparers and users of financial statements, the accountancy profession, academics, and the national standard setters. EFRAG legitimacy is built on transparency, governance, due process, including field tests, impact analysis, and outreach events, public accountability, and truth leadership. In 2018, EFRAG will work on a series of important projects. I would like to mention our endorsement advice work on IFRS 17 insurance contracts and our work on the possible interaction between IFRS 9 and long-term investment decisions. Valuation comes into play in these projects and almost all projects EFRAG is working on. I'm calling on all of you with an interest in financial reporting to contribute to EFRAG's due process and give us your input as part of our public consultation and outreach. Coming back to today's conference. Today we have two roundtable discussions. The first will address the theoretical aspects on fair value. This roundtable will be moderated by Peter Sampers, EFRAG board member and chairman of the Dutch standard setter. The second roundtable will discuss the practical aspects of the application of fair value in financial reporting. Andrew Washman, EFRAG Tech chairman and CEO, will moderate this roundtable. During the conference, we will use the Slido for questions. We will ask you to vote on some polling questions. Slido is also to be used for questions that you as audience would like to put to the speakers. You find instructions in your pack. Questions can be asked and Lincoln during the presentations and discussions. We will give priority to the most latent questions. If you go to polls, you see immediately the first question. We would like to run a test, so if you could all go to polls and respond to the question. Ready? We will now see the result of the screen. You have now some idea who is with you in the audience. Je ne vois pas. Let me now welcome our keynote speaker of today. We are delighted that Sir David Tweedy, well known to all of you that are involved in the financial reporting scene, is here today. Sir David Tweedy is the current chairman of the International Valuation Standard Committee. Sir David was the founding chairman of the ISB and, in the same time, CEO of the IFRS Foundation. During my 10 years as MEP and member of ECON, the Economic and Monetary Affairs Committee of the European Parliament, I had the opportunity to interact with Sir David at his presentation to ECON. Sir David is now active in the valuation area, an area of special expertise closely related to financial reporting. How close we will find out today. Sir David is willing to respond to a few questions after his presentation. You can put forward your question for Sir David through the Slido. Sir David, may I welcome you on the stage.
Well, good afternoon, ladies and gentlemen. Can you all hear me? I'm always reluctant to ask that question after my lecturing days at Edinburgh University when I've always said yes, but I'm willing to change with anyone who can't. There was a Texas billionaire who used to have the most wonderful parties, and at the end of these parties, he always did something rather different. And on this particular occasion, he took his guests down to a swimming pool, which he'd filled with rather large and rather hungry crocodiles. He said, the first man to swim the length of this pool can have either $10 million, the ranch next door, or the hand of my daughter in marriage. And the words were hardly out of his mouth, and there's a splash. This fella's coming along the pool, shouldering crocodiles out the way, and they haul him out the other end. That's fantastic. What would you like, $10 million? No. The ranch? No. My daughter? No, lovely lady though she is. Well, he said, what would you like? He said, I'd like to find the guy who pushed me in. And, well, I felt a bit like that with the IVSC. I wasn't expecting to be doing this. And what I want to do is just to run through, Jean-Paul said, the interaction between financial reporting and valuation. From my ISB days, it was quite clear that if you can have global standards, you have to have acceptance for them. And global didn't mean what it did when I was with KPMG, because you could point to global on a map. It was a big place with 50 states and sea on both sides. But it's much bigger than that. It really does mean global. And you must have a profession that can actually make these things operationalized. And that is going to be very, very important to do that. IFRS, its objectives were very clear. One single set of global standards, common reporting language. Do you know the accounting in India? Do you know the accounting in Thailand? Well, not yet, but if they do IFRS, you will. And that was the whole thing. Even Tim Geithner, who was Secretary of the Treasurer in the United States, he was a firm supporter. He didn't believe you could control global banks unless we all did the same accounting. Well, that's the sort of background to the IASB. And why then do you need global standards? In the UK and in other countries, your standards grew up because that's where companies got their money from, so the country set the rules. And it just spread. Starting companies wanted funds from elsewhere, investors wanted to diversify, and for example, on the New York Stock Exchange, 21% of the companies there are from overseas. It's 19% on the London Stock Exchange. But it shows you the effect of globalization. IFRS, 5 countries when we started in 2001. The latest figure I've been given, 138, and spreading widely. Sadly, not with the United States. It came very close, but I think the crisis probably put paid to that. But Europe, in fact, kick-started IFRS. The European Union's decision to adopt in 2005, followed surprisingly closely by Australia. That caused quite a few questions in Australia, almost as many as I got when I went to Sydney to discuss the issue with the Australian government, and was confronted by an immigration officer who was not an uncritical admirer of the Brits, and for some quarter of an hour asked me some pretty impertinent questions, finally ending up asking whether or not I had a criminal record, to which I replied I didn't realise I still needed one to get into Australia. But countries gradually, China is not quite there, but it's about 95% there. Israel 2008, Chile 2009, Brazil 2010, Korea 2011, along with an option in Japan, and 30% of their stock exchange now uses IFRS. Canada, Argentina, notice when next year we've got Mexico, Malaysia, Indonesia, so the Americans are surrounded, IFRS in both North and South, and most of South America, of course, is IFRS. So moving very quickly. But where does valuation come in? It's right at the core of what happens, both for financial reporting and for financial stability. In 2008, valuation practices were attacked as being part of the problem in the crisis. Christian Noyer, governor of the Banque de France, said at the time that uncertainty about the true value of complex financial instruments undermined global market confidence, raised uncertainty about counterparties' risk positions, and led to contagion across classes, markets, and regions. Lehman's, JP Morgan called in to rescue them, demanded extra collateral, which wasn't forthcoming. Bank of America walked away after doing due diligence. They found their valuations were billions of dollars different from those of Lehman's. And Lehman's own traders used different methods for exactly the same instruments. So the whole thing was a complete mess, and the markets just didn't believe Lehman's values. It hasn't quite gone away, because you've got a situation, 3 years ago, the Financial Stability Board said, the market valuations of banks in part reflected investors' concerns regarding banks' valuation practices. A transparent, consistently applied valuation of bank assets for regulatory capital purposes, in particular for illiquid and complex assets, would contribute to improving confidence in banks' balance sheets. Well, where does the IVSC come in? This will be a bit remote to some of you, but coming from Scotland, I'm used to that. And when I was at KPMG, I took 2 of my London partners up to the Hebrides Islands off the west coast of Scotland for investigation. And being London partners, of course, they had to keep up to date. And went into a newsagent to get a copy of the Financial Times and was taken aback when the old lady said, will you be wanting today's or yesterday's? But coming from London, they had to have today's. Oh, well, she said, you'll have to come back tomorrow. Well, IVSC started off with real estate, but the crisis made it clear that that was far too limiting. And it moved into financial instruments, business valuation, and it's gradually expanding as it comes round. It's the same objectives as IASB, and to be a global standard setter in the public interest. And what do we want to achieve? We want high-level, accepted international standards, same as the ISB. So if evaluation's taken place here in Brussels or in Boston, Bangkok or Brisbane, it'll be tackled the same way. We want to be referred to as the international standard setter, and we've got to do more about creating a proper evaluation profession. Because the profession has a lot of questions over it. Many of us who are trained in accounting would have learned how to value companies and other things, but that was just part of what we did. It was regarded more as a technique than a profession. And even now, there are so many different qualifications to be a valuer, a real alphabet soup. You can't really tell who are the cowboys and who are the good ones. And for that reason, the regulators have stood back a bit and watched what's happening. When you say, what is a profession? Those of you who are accountants will recognize this. You've all been through it. You have the organized body, you have the conceptual underpinning, I'll come back to that, and you have your entry requirements, your experience, your ethics, your discipline, and so on. And of course, you have continuing professional development. And we're requiring that now for organizations joining the IVSC. It's based on the accounting profession. And I'll come on to the significance of this later on. Well, the conceptual framework I want to look at. When I was at KPMG, my partners would have fallen over a conceptual framework without recognizing one. And I always used to show them this picture. A logical structure, one thing on top of the other. And in accounting, even these days, we have something a bit more like this. Those of you who know London will recognize the headquarters of the English Institute of Accountants, or rather the Institute of Chartered Accountants in England and Wales. I keep forgetting the Welsh, but so do they. One of their council members was heading for Wales when he was stopped for speeding on the motorway and apologised. He said he was very sorry. It was because he was going to Wales, hated the Welsh. Everyone you met in Wales was either a prostitute or a rugby football player. Oh, that's interesting, said the policeman, getting his notebook back out again. My wife's Welsh. Really? He said, what position does she play? But what I wanted to do is look at the accounting conceptual framework, and you can see the objectives, information for decision-making, stewardship, qualitative characteristics. Things have got to be relevant, a fair presentation, elements, what's an asset, what's a liabilities, we all know that, and that's why we miss them off the balance sheets. Recognition, when we can measure it reliably, and here comes to the gap. Valuation, big hole. There is no agreement on that chapter, and that's what causes a major problem. And it was for that reason that Hans Hugevorst and I agreed a protocol. What's IVSC's role? What's IASB's role? And it was basically that IASB would say when you use this value and what type of value. And IVSC would say, and this is how you get there. And to make sure we don't disappear in different directions, we really wanted to make sure each other knew what was going on. So you can see the sort of things that we've agreed. We input to the standards, we involve each other on the working groups that present them, and we work together. There is no friction whatsoever between IASB and IVSC. Well, what's the benefits if we can get this right? The first two are the same as ISB. Increased confidence across the markets. It was not there in the crisis, and as I'll come on to later, there are still issues. And of course, it's easier for everyone to do business if you know that things are being done exactly the same way. Might not get exactly the same answers, but it's approached from the same way in different countries. And for the individual valuers, their work becomes more relevant. It's one thing about IFRS. You can be trained in any country using IFRS, and you can go to any other country, 138 of them, knowing that your accounting is going to be the same. And of course, that helps business, but more than that, it brings into focus a more useful and valuable profession. Well, 2 years ago, we restructured IVSC. Those of you that know about it have probably forgotten about it. I find you do forget things as you get older. I was in a pub in Edinburgh not so long ago, and opposite me was an old couple, and the old boy mentioned that he'd been in a restaurant which had a terrific lunch, and I asked him for the name of it, and he said, oh goodness, Give me the name of a flower. Rose. No, that's not it. Daffodil. No. Lily. That's it, he said. Turned to his wife and said, Lily, what was the name of that pub that we're in there? Well, the structure is we have the council of our members, the trustees above that, and then what we've changed is we've got a standards review board, and I'll come on to the specialist boards in a minute, a membership and standards recognition board. This is the one that looks at people, or organisations I should say, wanting to join IVSC and says, well, do they meet the obligations I showed you a few minutes ago about entry requirements, exams, CPD, and so on. And the advisory forum is a group like the ISB's advisory council that just challenges and keeps up to date with you. Now, where does valuation impact financial reporting? In many countries, you can value real estate. Some don't allow it, but many do. Investment properties, IFRS, you have to. Intangibles. We're not very good at this. I remember, and it's delightful to see Andrew Leonard in the audience, that we introduced brand accounting when we were both at KPMG. And it was because Grand Metropolitan, it was then, bought Smirnoff vodka. And in those days, because of the rather strange British accounting rules, that would have been classed as goodwill, because it wasn't really a tangible asset, and written off against reserves. And not surprisingly, Grand Metropolitan objected. And we had a big discussion, and we agreed with them. This was an asset. Our big concern was, if we stuck it on the balance sheet, how did we know if it was still worth that? And what we did is we asked them, how did you calculate the value? And they did it by looking at the profits from Smirnoff and did a projected present value discount. And so you got a situation then, we had the figures. So what we agreed with the company was we were going to put the actuals instead of their estimates, and if that dropped the figure below the purchase price, it was going to be impaired. Now, you may recognize that because when Andrew also came to the Accounting Standards Board in the UK, we brought in the impairment rule for goodwill and brands, and then we transferred that to the ISB. It caused a bit of issues in the United States. I remember the chief accountant of the SEC being apoplectic, announcing that America had solved the accounting for brands and goodwill some 30 years earlier, and that was to write them off over 40 years. And as I pointed out to the gentleman in this country of UK, we have brands such as Gordon's Gin and Johnnie Walker that are actually older than the United States, and in my humble opinion have done more for the sum of human happiness than the United States. And personally, I'd write off America before I'd ever write off Johnnie Walker Blue Label. But the interesting thing about Grand Metropolitan was, having got Smirnoff on the balance sheet, he said, oh, we also make Bailey's Irish. And we said, no, you didn't write a check for Bailey's Irish. We're not sure what the value of that is, so we didn't let them put it on. But there's no doubt about it, it was as much an asset as Smirnoff was. And that is still an area that companies have a lot of assets off balance sheet, and quite rightly, well, at least I think it was quite rightly in my time, that the standard setters are not letting them go on balance sheet until we have an idea what the numbers are. And Mr. Murdoch lost millions of Aussie dollars, that's Mr. Murdoch, off his balance sheets with his mastheads, his newspaper titles. Yeah, they're assets, but we didn't know where the values came from and wouldn't allow them. Mergers and acquisitions, yeah, you can have intangibles there because people allocate it, but notice it's an allocation. There was a price. So the standard setters are just wary of allowing free run on valuations and intangibles and mergers and acquisitions. Extractive industries, what's the value of the reserves? Agriculture, huge arguments, believe it or not, over whether we should have cost or value in agriculture. I remember when discussing it with the Americans who wanted costs, and you think, well, what happens if a cow has a calf? Do you divide the cost of the cow by 2? Or do you estimate how many calves it's going to have, and if it's going to have 10, put a 10th? Or why don't you just value the calf like the farmer does? And the American wouldn't have it. Now, he kept going on about being brought up in a ranch in Oklahoma. And I remember saying to him, look, if you woke up one morning and you you twice as many cows as the day before. Would you not think you're better off? And he says, no, I think the fence is down. And financial instruments, derivatives, there is no cost. It's a contract. But if we didn't show the value, big gains and losses would just not be there. Pension schemes, we now show the full amount. We didn't used to 10 years ago. We never showed this. Liabilities, litigation, decommissioning, all big issues. And that's why we broke up the Standards Board of IVSC to look at specific areas. Business valuation and financial instruments were among the two new areas. And I'm going to look at financial instruments because when we did IFRS 13 with FASB, and it's pretty well word for word the same, we didn't do very much in valuation, and that was deliberate because we didn't think we were the experts, and we kept away from it. We gave a few hints, but didn't go very far. And we made it clear that we believe the valuation should be done for reporting, not prudential purposes. We don't want to get some low artificial value. We want to make sure one is that we actually believe is the value, and that's what goes into the accounts. And yet we see things appearing in accounts that think that doesn't look like the fair values that FASB and ISB were coming out, funding adjustments and so on. What are we going to do about that? The trouble is fair value is not that popular. Accountants like cost, but there's not many things that cost these days. And cost leads to profit manipulation. The South African gold mines, they used to wait until near the year end, and they only counted gold at value when they stamped the bar. So you can imagine what happens the week before, how many bars do we need, and bang, bang, bang. If they're valued, they can't do that. So it takes that ability to remove it. But in the crisis, fair value is extremely unpopular. I was interviewed on the BBC World Service, and during the course of that interview, the interviewer said, in this crisis, fingers are pointing, and fingers are pointing at you. You are the man who's caused this crisis. And I said, they're right, it was me. I made banks give up all the risk management techniques. I made them give loans to people who had no income and no assets. I made them take these mortgages, break them into tiny bits, add them to tiny bits of thousands of other mortgages, scatter them worldwide. I made the credit rating agencies give them AAA ratings. I made people buy them without any due diligence. This is all my fault. And there was a silence, and the interviewer said, for the benefit of overseas listeners, that was irony. Well, it came home to me, and the reason actually probably I'm standing here now was just probably 6 weeks into the crisis, I was meeting in this city with the Financial Stability Board, the ISB is a member, and everything was going south. People on their BlackBerries. I have genuinely never smelt such fear in a room. I think there was a real concern the whole capitalist system was going to blow up. And Mario Draghi, who was chairman of the Financial Stability Board at that time, turned to me and said, David, what are you accountants doing about valuations? And I said, nothing. It's not our job. We take values. Other people are doing that. Well, who are they? Good question. Didn't find any. And so FASB and ISB had to get together. What do you do in illiquid markets? Firstly, don't take fire sales, because that was making the situation worse. But that shook me, that so much of the balance sheet was relying on values, and yet there was nothing out there. So what was happening? So when I was asked to do the IVSC, I went to the regulators and said, what is happening out there? And then you heard stories about hypothetical portfolios being sent to the major banks and them being asked to value it. And the differences were as much as 140%. And so you say to the prudential regulators, if that's going on, what about your capital buffers? And they say, that's why they're so high. We don't trust the values. So we stick up the capital required. And you remember at the time of the crisis, the world's major banks, their equity level was only 2%, 98% borrowed. So you don't have to lose that much. And they did lose that much. 1/4 of the world's GDP at one stage was propping up the banks. And that's the sort of issues we've got to be very careful doesn't happen again. And it's not just balance sheet figures, because being cynics, we standard setters say, okay, you can have loans at cost, but we want to know the fair value of them in the notes so we can check whether you're impairing them properly. And we had a case, a cooperative bank in December 2012. It showed its loans, and the note said the fair value of these loans were 37 million more than amortized cost. Well, by the time the regulators had finished, they realized that perhaps they should revalue them a different way, and they turned out and said that actually they were 3.7 billion less. So it's not just numbers in the accounts, it's the numbers in the notes as well. Well, we knew there was an issue to be fixed, so we got the regulators, the audit firms, the valuation firms, insurers together and said, is there still an issue? Yes. Is it fixed? No. What do we do about it? And we proposed then to set up a task force and to try and come forward looking at financial reporting. That's the target and how we do that. And what I'm trying to emphasize is poor valuation affects the balance sheet. That means it affects the income statement. That means it affects the capital buffers and financial stability. And that's why it's so linked with financial reporting. So we decided that we would have to set up some working groups to look at it. What about governance? What about independence, management, information? What control systems have you got? What sort of framework? What's the step-by-step way of dealing with this? Understanding the nature of the instrument. What's the uncertainty? Does the model work in all situations? Is the data you're putting in of an appropriate quality, and so on? And then there's data itself. What do you do in liquid markets? What do you do when there's no data? What do you do when there's incomplete data? Where do you get it from? And is this why banks' equity prices are so low compared to their book value? Is it due to a lack of trust? And then finally, what about financial reporting? We have a standard, but where's non-compliance happening? What about this funding adjustment? I don't notice funding adjustments against treasury bills, so why have we got them in other areas? Is that fair value? These are things we want this working group to look at. So where is the conflict between what people think is right, or even they don't think is right, what they do, and the accounting standards? What about the large holdings? Should there be a discount because you have to get rid of them? Or is it a control premium? Or is it P times Q? When we tested against a group of bankers at a conference, 80% believes that fair value standards, accounting standards, and what the market does are different. And 3/4 of them wanted tighter standards. And that's where the IVSC perhaps can help. And what we want to do is have these discussions, get a consensus that the regulators, the auditors, the standards boards, and the preparers think is fair, and then set out the standard. And we've tried to simplify financial instruments. IAS 39, which I always say we inherited, I used to say, as many of you probably heard, that if you understood IAS 39, you haven't read it properly. And we had huge fights, especially with the French banks, but I'm glad to say when I left in 2011, we operated in an atmosphere of mutual trust and understanding. They didn't understand me, and I certainly didn't trust them. But now when I go to Paris, I'm treated like a king, and you know how the French treat their kings. Well, IFRS 9 was a much simpler technique. If you knew the valuation, if you knew the cash flows, and you were holding the instrument to get these cash flows, you could have it at cost. So we're only talking debt and loans. Everything else at fair value. So there's the principle. Since then, there's a sort of available for sale come in. You could not have sold available for sale in 2010, not after the crisis. So it was black and white, value, cost. One in the P&L, all gains through the P&L. There was nothing going to go to OCI. But things at cost have problems. We brought in the incurred loss model, both in the States and in IFRS. And it was because the previous model was based on the principle of a gleam in the eye. You know, if you fancied a provision, go ahead. Bad years, you could bring them back. So the incurred loss model, you had to have evidence that there was something there. It didn't have to be a default, just evidence. And it was on the basis such as, if you had a downturn in the oil industry, you had an oil town like Aberdeen in Scotland, lots of mortgages, there are going to be layoffs, you know you're going to have some defaults, start providing now. You don't have to know who it is, just start providing. But in the crisis, they didn't. There hasn't been a default yet. That wasn't what the standard said. And then a big uproar came out that, the standard's flawed, that people are not able to provide. Oh, yes, they were. And where were the auditors? Sometimes our auditors have all the backbone of a chocolate eclair, and that was an opportunity missed. So the politicians dived in. Clearly, there's a big problem in the standards, and we're going to get expected loss. So you don't need trigger events. You update it. How you estimate it's going to be an interesting question. And you look to future expected events rather than past or current conditions. You know, sometimes you ought to give advice, and this was in my time as well. This is not blaming anybody. But I remember I'm reluctant to give advice. I remember when I moved to my present home near Edinburgh, we had a architecturally splendid plant in the front garden which looked like overgrown parsley. But the neighbours who didn't like the lifestyle of the previous occupants thought it was marijuana. So I was concerned, and I called in a horticulturalist. And he didn't know what it was either, but he gave me advice I never forgot. He said, look, if you're worried about this plant, he said, pick it, dry it, and then smoke it. And if you're still worried about it, then it's parsley. Well, I'm not sure this is the right way to have an impairment test, but it's what was forced on us by the politicians, and it's going to be a problem. And sadly, FASB couldn't agree. And that is going to be a difficulty for the world financial markets, because they're very different, well, based on expected losses, but IASB is taking it in a more general way, just let's look a year ahead, and if there's something happens, okay, then you make the adjustments, but leave it till then. The Americans are quite different. Take the hit, right up front. So it's simpler, it's more conservative, and do the prudential regulators like it? So why didn't IASB follow FASB? Well, firstly, it distorts the loan book. You give a loan, you take a loss. That isn't what happened. That isn't the economics. Depresses share price, obviously. But what worries me is, if you've got a downturn and you've written these things right down, why not sell them and take a gain? So here comes profit manipulation in a different way. And in bad times, of course, in economic terms, you don't want losses, so don't lend. So I don't see that this is a crashing in good standard. My American friends know I think this, but that's a problem. And it was a problem with the breakdown in the convergence program. Americans wanted to go their own way, and that was a difficulty. Well, where do we go with the valuation profession? It's going to be in unison with the accounting profession, because we're going to need people to help police any form of financial instrument standards, and that could well be the accounting institutes who'd help look after it. We want to make it tougher to be a valuer. We want to have a recognized global credential like CPA, CA, that people know that this guy's okay, and do that. And we want the regulators to start using it. So there's the link. Valuation is at the tough end of accounting. Balance sheets have very few numbers that aren't estimates or values. And what we have to do, both accounting and valuation, is work together to get there. Well, that sounded a bit like a sermon. I was in church not so long ago listening to the minister going on, and eventually an old lady in front of me turned to a neighbour and said, is the minister no finished yet? And back came the answer, he's finished, he just can't stop. Well, let me assure you I can. Will we win in valuation? I say the same as we did about accounting standards. I don't think of it in terms of winning. I think of it more like the cross-eyed Olympic javelin thrower. He didn't win any medals, but by God, he kept the crowd on the edge of their seats. Thank you very much.
So David, thank you very much indeed, and you've kindly agreed to stay for a few questions.
There's none.
I have some here.
Oh.
Let's bring up the Slido questions on the screen if we can, though, please. So we're democratic around here, and we have actually a three-way tie. So you can take your pick, but the first question is, how can IVSC standards actually be adopted? Who actually needs to decide?
Well, it's the same way, really, as the ISB standards were adopted. You had somewhere here the regulators, in this case it was the European Commission, sort of pushed them. In other countries, Australia, it was the regulator. And I think it's the same way. That's the reason we're talking to IOSCO and going through, showing them the sort of issues that we've just discussed and what can happen, and making presentations at IOSCO meetings. So gradually, that's the way I think it's going to happen, Andrew.
Thank you very much. We do have a front runner now. So, to what extent do you see national or regional variations in valuation standards or valuation practices that create the same sort of need or demand for international harmonisation?
Well, it's there, and if you look at Europe, there are European valuation standards, and you're going to need something different in Europe because you're going to have European directives, and we're not going to deal with that. That's going to be something that Europe has to deal with. I think what I would like to see, though, is Europe adopting the IVSs for the generality of the standards, and when it comes to something special that Europe needs, using that, not writing yet another one. I always refer to the problems with international standards are the 3 C's. You've got change, then there's the cost of change, but the big one is loss of control. And that's the issue, is sovereignty. And if you want global standards, you've got to concede some of it.
Okay, thank you. And are there any issues with valuation that have taken you by surprise?
I was quite shocked at the differences in the valuations of some of the financial institutions. Some were aggressive and others weren't. And the regulators were estimating if you took the sort of continuum and those in the middle went down to about the 75th percentile, it wipe out their equity. That is scary. And the idea is, can we solve this before we have the next crisis? Or we're going to find afterwards that's what happened. And I think it's quite obvious which way we're better to go. So that's what I think has been the biggest surprise. I didn't realise there was quite such big differences. And the trouble for the regulator is if he comes along and says, you're too aggressive, the answer is, where's the benchmark? There isn't one. So that's why we need the standards.
Very good, thank you. And let's just take one last question because time is against us. So you can take your pick. Should accounting standards sometimes require the use of a certified valuation professional, or perhaps would you prefer to address, is it a contradiction to prepare going concern financial statements that then carry liabilities at values reflecting market consensus of the non-payment risk? It's a bit more technical, that second one.
It was, wasn't it? Well, let's take the first one because it's easier. And I've now forgotten it. What was it?
Should accounting standards sometimes require the use of certified, not certifiable, certified valuation professionals?
Well, I think that's the ultimate. I remember when the IVSC was first formed, when I was still chairing the ISB, and that lovely guy, Michel Prada, came and said, David, can you insist an IVSC standard? And I said, I'd love to, Michel, but I can't, because they're not accepted widely enough yet. And we need to get that acceptance, because what we can't have is IFRSs being not used in certain countries simply because they don't use IVSC. So we've got to do our bit, and then I would hope that it would come forward and regulators would insist on it, because that's the way it'll come on.
Very good. Well, sadly, time is against us, so thank you very much for joining us for our event and for those fantastic insights. We wish you luck with your endeavours at the IVSC, and can we express our appreciation for Sir David in the usual way, please? Thank you very much. Okay. It is now time for our first panel discussion on the subject of fair value accounting, the theory. So could I welcome our panellists and Peter Sampis, our moderator, up to the stage. Peter, as you've heard, is, among other things, chairman of the Dutch Accounting Standards Board, and most importantly, a member of the EFRAG board.
Thank you, Andy. We are still waiting for 2 panel members who are getting their microphones in the back, so that's if you bear with us just a second. I see also that will take 1 or 2 minutes. So why don't I already kick off then and also start introducing the panel, hoping that the missing members will be in time here when I reach them to be sitting here. Welcome to the fellow members of the panel, of the first panel, where we will be discussing a bit more the theoretical aspects of fair values and the importance of fair values in accounting. To my left, and for you the right, Ann Taka is with us. Ann has been appointed board member of the IASB in July of this year, so it's still quite fresh. But no doubt she has strong and well-established views on fair values, also from her previous career as a professor of financial accounting at the University of Western Australia's Business School. So in that sense, she's well-equipped also to bring forward her views. And thank you, Ellen, for being in time, because I was just going this direction of the table. Ellen Dekkers joins us. Ellen is head of the team that is responsible for corporate reporting and transparency at the European Commission. So very well placed to discuss with us. He has been with the Commission for nearly 20 years. And prior to that, he graduated in physics at Manchester University, I learned, which was new to me. So he can also bring us perhaps also a more technical view if we need that on fair values. Jannis Bischoff also just took his seat. Jannis is a professor at the University of Mannheim in Germany, where he chairs the accounting department. And his area of research, interestingly enough, is on, let's say, the meeting point of financial accounting and banking. And again, how better could you place fair values than in such an interesting meeting point of two important streams in also economy. Vincent Papa, on my right, for you on the left, joins us. Vincent is the Director of Financial Reporting Policy at CFA Institute. And as many of you will be aware, CFA Institute represents a large group of professional users of financial information. He is a CFA charter holder and also a US CPA, I learn. So in that sense, welcome with us, and we hope to benefit also from your insights. And then last, but certainly not least, Mauro Bini. Mauro is a professor at Bocconi University in Milan, and well placed here today because he's also chairman of the board of the Organismo Italiano di Valutazione. Now, I hope that sounded a bit like it is used to sound in Italian. Mauro, welcome. We look forward also to your views in two ways, because you will start off the discussion and the debate by also giving us a short introduction on your views and also some of the academic thinking behind fair value and the importance of fair value for financial decision making. So please enlighten us with your views.
Thank you, Peter. I have a few slides. Okay. It's a special pleasure to address this first roundtable about fair value, the theory. I am a university professor, so the theory is my natural environment, as you know. So I would like to give you in a few minutes a sort of helicopter view of literature about the theory of fair value, following a chronological path. And the four main strands in literature about fair value are as follows: fair value and predictive ability of income, fair value and accruals, the classical trade-off relevance versus reliability, and the so-called reliability costs. The first one, fair value and predictive ability of income. I have to say that what we know perfectly, that income be considered the difference between net asset as the beginning and the end of the period. But if you incorporate future in the net asset, the natural consequence is that earnings will be less predictable. And so we can say that fair value accounting makes earnings less predictable. And in the past, a question was, is this an issue? And there was a school of thought that considered the predictability of income an indicator of quality of accounting. I don't think so. Why? Because we are not interested in stable income in a volatile world. Because, of course, in a volatile world, we will have a volatile intrinsic value. We need an income that is able to give us predictable information about future cash flows, just because intrinsic value is a function of future cash flows. And if we want more efficient markets, financial markets, we need more informative income, especially about future cash flows. So fair value is a mean, not an end. And in particular, we have to consider that a stable income in a volatile world is a real poor indicator of future cash flows. The second strand in literature was about fair value and accruals. As you know, fair value accounting is not cash flow accounting, okay? So accrual matters in fair value accounting. In particular, unrealized gains and losses, of course, okay? So, as you know, usually we consider that net income is a better indicator of performance of a company just because there are not negative serial correlation as we have for cash flow. This is a typical textbook example. If a company purchases inventory for 90 at the time 0, the cash flows decrease by 90 at the same time, but earnings are not affected. And in the next period, we will have, for example, the possibility to sell the inventory for 120, and so the earnings will be equal to 30. So what is a better performance indicator? The stream of cash flows, minus 90 plus 120, or the earnings? Okay, accruals are an anchor for valuers. This is very important. And so the question is, are fair value accruals an anchor too? And the question here, the answer here is more complicated. It depends, not always, because incorporating fair value into historical cost accounting could be challenging, in particular because it involves the separation between the regular income or net income and comprehensive income effect, and the recycling of items of regular income into comprehensive income. So it depends, in particular, on the business model. We have to consider that a fair value is an exit price, so fair value accounting is an exit price accounting, okay? And the exit presumes a willing seller, okay? And but some assets will never be liquidated by the company. It depends on the business model, okay? And the price presumes active markets, but many times we have to estimate fair value for assets without market, for hypothetical market participants in hypothetical markets, and this is very difficult to estimate, okay? So we can consider that fair value measurement can be high informative or low informative, reliable or unreliable. As an example made before by Sir Tweedy, there was the example of the brand of vodka that was unreliable. It's very difficult to estimate, okay? And this is the case of intangible assets internally created. We don't have today reliable methodologies to estimate them and to recognize them in the balance sheet. But this opens the door of opportunistic behavior by a company. For example, an intensive intangible company can reduce R&D expenses today, okay, without any effect on the value of intangible assets because they are internally created and they are not recognized in the balance sheet. And the effect is a higher profitability today, and we are destroying value of technology internally created, okay? So in any case, we have trade-offs, okay, between the informative characteristic of fair value and reliability of fair value, of course. It depends on the different business models. So diversity in business model, literature tells us, needs optionality. And so the possibility to change the extension of fair value measurement at different assets and liabilities, just for considering the different business models. And this could have effect on the distinction between comprehensive income and net income. But optionality opens the door to opportunistic behavior, of course, and so it raises the risk of reliability. And this is my third issue, the classical trade-off between reliability and relevance, economic relevance. I have to say that the majority of academic literature about fair value was about this classical trade-off. And the majority of literatures tells us that fair value is economic relevant. And it is economically relevant even when the markets become less liquid. And this is very, very important. But, however, we know also that fair value level 3 is much less relevant than fair value level 1 and level 2. And we know also that gains and losses of fair value measurement are not relevant. So we have a reliability problem here, and in particular we have to consider that it is possible that standards do not work as intended at level 3, and we could have inconsistent application of measurement as the beginning and as the end of the period. Okay? And so this opens the door to the classical problems of information asymmetry and measurement error. Information asymmetry is a source of agency costs. And you know that agency costs are driven by adverse selection and moral hazard. A classic example of adverse selection in fair value accounting. Two property investment firms with equals, except one has a high quality portfolio and the other a very poor quality portfolio. Okay? If the information are not credible or reliable, the market presumably will give the same value as the shares of the two companies. How can the company with a high quality portfolio to signal to the market that the fair value of his portfolio is more reliable, is more closer to the economic value of the portfolio? Theory tells us that this company has to give a credible signal, and a signal is credible when it is costly. So, for example, the company can sell a part of portfolio showing that the selling price is very close to the fair value, or the company can hire an external appraisers just to evaluate, with a credible appraisers, evaluating the portfolio, for example. Okay? But we know from the theory that the signal to be credible must be costly. And these are the so-called reliability costs in literature. And we have to consider that reliability costs can influence the choices of the firm. Moral hazard. Of course, you have the possibility that managers may use their private information to their personal advantages. In those cases, I think that the best solution is disclosure. Okay? Disclosure about the methodologies, disclosure about the main assumption and so on, and just this could be the theoretical solution for this issue. Information precision, so measurement error. In this case, we can distinguish between two kinds of errors. Noise, what we call noise in literature, so intrinsic measurement error. Something that is difficult to evaluate. the inherent risk of the asset, okay? And the bias, the management-induced error. Okay, we can consider that sometimes at a level 3, we have a big issue about inherent risk, in the sense that we have to calculate the hypothetical price in a hypothetical market for an hypothetical market participant. This is very difficult, okay? And but this is not linked to the fact that we have a bias, okay? This could be a problem from an auditing point of view, but the bias is the real enemy of fair value accounting, because in the bias there is the lackness of trust from the users of accounting. And in that case, we have to consider that regulators has to establish how much latitude to give managers in the estimation of fair value. And presumably, this is the next frontier of fair value accounting, at least at level 3. The final consideration is about reliability costs. I want to distinguish between fair value of financial instruments or financial assets and fair value for non-financial assets. We know that for non-financial assets, when we have an optionality, and so we have the possibility to choose between fair value or historical cost. The 90% of companies prefer historical costs. This is counterintuitive. Why? Because we are sure that we have net economic benefit in using fair value. And if we believe in the free market discipline, this is very difficult to explain. Why they choose historical cost if they can have benefit? Presumably because the reliability costs are too high. And so, presumably, the academic literature has to analyze this kind of costs, the reliability cost, how costly is to send a credible signal to the market. And I am sure, as Sir David told before, that evaluation profession can reduce the cost, the reliability cost, just because professional valuers can follow a same body of knowledge, same rules, same standards, and this can create more trust in valuation. So I have finished. Thank you.
Yes, thank you very much, Mauro, for giving us that first insight and also highlighting to some extent the difference between reliability and informativeness and the fact that those two concepts are very closely interlinked, certainly if we start to think about the use of fair value information. Now, before opening up the debate with the panel, we have sophisticated technology in the room, so we have all been equipped with a link to Slido. And why don't we first do a polling question just to set the scene before we continue with the discussion. The polling question has to do with an application of fair value. So a company has an office building that is located on a plot of land that was acquired a long time ago. The land could be sold, but the company has no plans to do so. Do you think then that the fair value of that land is relevant information for the users of the financial statements? We have three options. No, it's not relevant. Yes, mainly for assessing stewardship. Or yes, because it has additional information about future cash flows. So in a nutshell, those are the three choices that we have. And we see 30 votes being in there now. And it's a neck-and-neck race between... It is, yes, but I was in the neck-and-neck race now. We see indeed that stewardship is making the gain, and I think in the end, with 43 people having given their view, that it is relevant, and principally everybody, or 50%, half the audience, thinks that it is relevant because it gives good insight into stewardship and the way that management actually used the assets that were available. I will not ask now for an interpretation and a debate on this position, but at least we see a large majority, because that's also a way of slicing the outcome, that is finding fair value information relevant and useful, even in a situation where it doesn't really predict actual operations in the markets. So in that sense, I think that's already a good takeaway from that first poll. Thank you for your contribution to that. Now, we have a number of questions that we want to discuss in the panel. And yes, if you want to discuss questions in the panel, of course, you have to start with the basic principles. How do we see the role of fair value in bringing transparency in financial information, but also comparability in that information? And related to that also, in which situations, if any, would fair value information be more relevant for users? So that basic question of, is it relevance bringing better transparency and more comparability, and under which situations is that the case? And Anne, perhaps you would kick us off and give your views on that, and then I'll invite some others to also reflect on that.
Thanks, Peter. So I think we would agree that transparency and comparability are important attributes of financial information. And at times when standard setters make use of fair value measurement, they are indeed trying to increase that transparency and comparability. Presently, we're engaged in our post-implementation review on IFRS 13. And the feedback we're getting is that people have found the disclosures around fair value measurement to be useful. They have found disclosures about the hierarchy, levels 1, 2 and 3, disclosures about the inputs, disclosures about sensitivity, disclosures about inputs into models. These are new disclosures that have come post IFRS 13, and we're getting feedback that people are finding these beneficial. We take that to mean that those new disclosures are benefiting users and benefiting markets because they're providing more transparency than was there before, and they are providing comparability in places where it was missing. So, that said, of course, it's not just a matter of the disclosures being provided in accordance with accounting standards, it's about those disclosures, the quality of them, and that will, of course, vary between entities and between people, the quality that they put in there. We also know that the comparability and the transparency of these disclosures will reflect the markets that they're happening in. So there's an element there, Peter, where it's to do with the actual market where the information's being generated and the skills of the people in those marketplaces. So there's a number of layers and elements to your question about comparability and transparency.
Okay. Thank you very much for those first thoughts. And then if you say it's also to do with, let's say, the use that users make and also the way that users can interpret the information, I already have a logical bridge to go to the right-hand side and to ask Vincent on the views also of you, but also of users in general, sure, on the usefulness of that fair value information. Vincent.
Sure. Thanks, Peter. I would back what Hans mentioned. Fair value measurement has certainly spurred greater transparency. So the recognition and measurement requirements are just one piece of the puzzle. It's just worth saying as well that from a user standpoint, there's also the question of the relevance versus reliability trade-off. And I think, as has been mentioned by Professor Bini, there are various components to the reliability question. There's a question of the bias that is inherent, and then there's a whole issue of inherent measurement uncertainty. The question arises as to whether fair value measurement has incremental opportunities and incentive to have upward bias relative to any other measurement basis. And that's hard to ascertain. But I think it's fairly clear-cut as far as inherent measurement uncertainty is concerned. It's a big issue with fair value measurement. When you look at, from an auditability standpoint, when you look at the ranges of fair value compared to the materiality levels, they tend to be quite high. So inherently, there's that question around how much assurance can be provided on any number that's reported. I think the Professor also did mention the quadrant of reliability versus informativeness. And that's fairly consistent with the views we've been able to glean from a CFA Institute standpoint around their views around where it's appropriate to apply fair value measurement. So during the financial crisis, we did conduct surveys to try to get a sense where do investors have preferences for different assets and liabilities being measured at fair value. I think, as we all know, investors have diverse viewpoints. It's really hard sometimes to generalize. It depends on the user group you're speaking to, the roles that investors have, the horizon of analysis. But it's fair to say that we did find for the more tradable instruments, where there's clear separability of the type of asset, there's strong support. There tended to be majority support for loans, deposits, and financial liabilities. And for non-financial assets, there's very low support for that. I think it's also helpful to decompose when you're talking about relevance, the whole valuation relevance, to decompose between the income statement and the statement of financial position. So from an income statement standpoint, I think what's worth bearing in mind is that the P&L itself is an amalgamation of different types of line items of varied characteristics. And when you look at the popularity of non-GAAP reporting and the type of exclusions that tend to characterize, you also find that fair value remeasurements tend to be adjusted by many companies. That in itself is an indicator that when you strip out the fair value remeasurements, you're more likely to get to what you deem to be more sustainable and persistent earnings. But that being said, I think the point I would mention on the whole question of valuation relevance would be more along the lines of, I think, Olson, the academic. Yeah. Valuation relevance is not just about persistence or sustainability. There's predictive value, there's risk relevance. And I think you need to look at the combination of those. So there could be situations where fair value remeasurements may not be persistent, but they could have predictive value. Yeah. So there have been studies, for example, which have shown that cash flow hedge remeasurements are predictive for future cash flows. And that's certainly helpful or worth considering when you're thinking about the inherent information characteristics. The last point I would mention would be around balance sheet analysis. And there again, there'd be the question as to whether a net asset value based on fair values is more useful for investors when aggregated. And for particular sectors like the insurance industry, there's been some indication whereby when you take price-to-book ratios based on considering fair value measurements, you have more relevant valuation metrics relative to when those are excluded and they're not recognized. Yeah. But it's just worth saying because often the question is posed as to whether investors expect fair values to yield price-to-book ratios that are 1. In other words, is accounting valuation intended to supplant financial analysis? Yeah. And the answer is no. I think all you really need to look at is business models where the predominance of fair value is quite evident, like asset management firms. Yeah. Price-to-book ratios there are not 1. Yeah. So there's a lot more that goes to valuing companies just beyond taking what companies disclose on a fair value measurement basis. Yeah. There's a recognition that balance sheets are not complete. There are thresholds to recognizing assets. There's also the recognition that assets, their values also depend on other assets. And it's hard to glean that just by aggregating various assets and liabilities which are recognized on a fair value measurement basis. Yeah. So I think it's helpful to have that decomposition when you're thinking about relevance.
Okay. Yeah. Thank you very much. That was a very comprehensive view also on the relevance of fair value information. I think in the end, indeed, if accounting information was so informative that it would immediately give the market value of equity, then first of all, analysts would be out of a job, but also probably we would be living in a perfect world with no uncertainty. And I'm afraid that that's not there for the near future to come. You gave us a lot of interesting avenues to pursue on. You also mentioned the relevance of non-GAAP information, and we may return to that a bit later on. But you also, interestingly enough, said, well, in the financial crisis, we spoke to our members to see how relevant they found financial information and what type of information. And I think that's a good bridge also into the second question, because obviously the global financial crisis created uncertainty, created questions with respect to fair value information, gave rise to criticism. David Tweedy mentioned that earlier on already. But it also could be an opportunity, because under stress you learn how systems really work and where risks and in the system are. So what could we learn, or what have we learned from the global financial crisis, and then particularly about the use and usefulness of fair value? And yeah, Jannes, you have been on the intersection of both banking and financial accounting, so in that sense you could say in the central point of that debate. What's your view on that? What could we learn?
Yeah, thanks a lot, Peter. And that's certainly an interesting question, because the academic debate took an interesting direction in the post-crisis period. Well, at first, it's certainly fair to say that fair value was blamed to a large extent for what happened during the crisis. Now, with plenty of academic evidence in, and with the benefit of hindsight, the view is well, much different, and we can probably say that much of this early criticism of fair value and its role during the crisis was not, at least not sufficiently well-founded. I mean, first, we look at potential direct effects, and we look at the balance sheet structure of those failing banks. Evidence is pretty robust that for many of these failing banks, fair value accounting simply did not play any meaningful role to explain what happened, especially in the US, but also if you look at some of the European cases. Second, even for the indirect effect, you know, when some bank is facing fair value write-downs and is argued to be forced to sell some of those assets, and then these forced asset sales trickling down through the financial system. This theoretical argument is mainly based on some early theoretical papers. And when we look at these papers and the assumptions that these models are based on and benchmark these assumptions against reality, this is not really consistent. We've heard from Sir Tweedy's discussion early on that, I mean, fair value write-downs are protected against fire sales. You're not supposed to consider these fire sales prices in fair value measurement. Even if you do, even if you take those fair value write-downs, regulators have a lot of prudential filters in place. We know that in some countries, such as Germany or Spain, even introduced those filters during the crisis. So even if you have fair value write-downs, they do not go one-to-one into regulatory capital, at least not necessarily. But that's the main mechanism in all those papers that, well, this early criticism of fair value accounting was based on. And then I think we also must be very careful to distinguish between, well, accounting-induced use of fair value and accounting-induced fire sales, and the use of fair values in private contracts, margin calls or collateral requirements. You know, when these private contracts, these private agreements trigger fire sales, that's something that accounting regulation cannot really do something about. And I think we need to separate this criticism from the criticism that affects accounting regulation. So that doesn't mean at all that accounting didn't cause any problems during the crisis, but my personal view, and I know that at least some of my colleagues also share that view, is that, well, the problems were probably somewhere else and not in the field of fair value. Look at the lack of timely impairments, where IFRS 9 is a big improvement. Look at the lack of standardized and well-enforced disclosures. So it does also not mean that fair value does never cause any problems. It just means that the evidence we have from the crisis, that this evidence is not powerful enough to make any strong case for or against fair value.
Okay. Thank you for that view. Now, of course, some of the criticism was raised not so much towards the academic world, but also towards the standard setting world. Pro-cyclicality was mentioned as one of the, at least, confounding factors in the crisis. And perhaps you already said we have been evaluating IFRS 13, but also thinking about that criticism, has it led the IASB to second thoughts, to new insights with respect to possible risks of fair value accounting?
Yes, Peter, I think the crisis has had a big impact on IFRS and the IASB. I just want to echo with what Yannis has said from the academic community, that early on there was a lot of blame to the fair value accounting standard, and I think all credit to the academic community who have spent 10 years investigating that thoroughly. Certain areas have been investigated, and the consensus has moved away from that initial blame. But that's not to say that the standard setters haven't responded and given a lot of thought to the standards. Sir David pointed out weaknesses in IAS 39, and he also indicated his belief that IFRS 9 is a better standard. He didn't tell us that it was perfect, and he certainly didn't tell us that there won't be difficulties with the expected loss model. But he did indicate to us today that IFRS 9, he believes, is an improvement on IAS 39. But I think an enormous amount of work has gone into standard setting in the financial instruments area post the crisis, as you would expect. It was taken very seriously, and we heard that again today. So the IASB is working very closely with key people, via the MOUs, for example, with the Basel Committee, with ESMA, with IOSCO. It isn't the provenance of any one organisation to look after all the issues, and we've heard today about standard setting and standards for valuation. But we're now touching on the business of accounting entities, the standards, the banking regulators, the capital market regulators. So we can see the need for them to be working together, and that is something that has been very front and centre for the IFRS Foundation and for the IASB. Immediately post-crisis, an expert committee was set up, and people at the IASB and IFRS Foundation were working with that expert committee in working out how to do fair value measurement valuations in illiquid conditions. And some of that work did then filter through into IFRS 13. So I think also the IASB now will emphasise a lot more through the conceptual framework, which we're about to issue next year, but many of you will have seen the exposure draft for the conceptual framework, and that does affirm the approach of the mixed measurement model. The mixed measurement model in accounting is the reality that we live with. There will be times where fair value measurement is the preferred measurement base when we think about relevance and representational faithfulness, when we consider them both together and think about the users that Vincent is referring to. There will be times where fair value measurement is the best measure in the view of the standard setters, but that's within the context of a mixed measurement model, and that's clearly articulated in the framework.
Yep. Okay, thank you for that. Other panel members who want to share their views perhaps on the impact of the financial crisis? If not, then I suggest that also we give the audience a bit of floor. So if there have been questions that came in, then this is the time perhaps that we can see them. And yes, there have been questions. And well, one question that was on the top of many people's minds, because I see that we have 8 people asking that question, because fair value is subjective, if there are no observable inputs, how can we measure fair value? Yes, how can we measure fair value? Now we're really getting into potentially the nuts and bolts. Mauro, can you help us a bit on the how question, how we could measure fair value reliably, because that's, of course, the contentious part of the question.
I have to say that we need to understand what is an estimate of a value. Okay, an estimate of a value is an opinion, it's not a fact. Okay, and we need to accept this. But an opinion can be well structured, following standards. So I think that even if we have to estimate a fair value for an asset without an active market, presumably we are able to follow the mechanism followed by an hypothetical market participant in estimates the value of the asset, for example, using an income approach instead of a market approach. The problem is in using an income approach to have the perspective of market participant. I want to give you an example. Many times in the calculation also of financial assets, at level 3, there is a confusion between fair value and value news, because an asset can have a value news that is different than a fair value. Okay? And this is typical the case. In literature, we know that when we have a transfer of assets from level 2 to level 3, the valuation coefficient applied by the market is much lower. Why? Because usually the preparers don't use a liquidity discount as the market apply to the asset. Again, this is a measurement error, okay? But this measurement error is made just because we don't have enough standards to explain how to calculate the value. I understand that this is not something that can be covered by accounting standards, but I think that we have to consider that fair value accounting is a table with 3 legs. The first one is accounting, the second one is valuation, the third one is auditing. Okay? And so we need to work together in a coordinated way in order to have something that is acceptable. Okay? I think that, of course, a fair value for an asset without an active market is a conventional value. Okay? But it's very important that this conventional value cannot be calculated with an opportunistic behavior. Okay? If we have the same rule and we follow the same rule, presumably, we are able to calculate this conventional value in the same way. I think this is the solution, at least for a valuer. Okay.
Because there is the remaining issue, of course, that even if we have a model and if we have the input parameters, still there is a lot of judgment on which parameters to use and how to model the value. So opportunistic behavior can be an issue. On the other hand, if you have a range of values, then probably it's more informative than knowing nothing about the future, because that's probably the downside.
Faithful representation is not a certain outcome. Okay, so we need to accept the idea that faithful representation is neutral representation. It's not biased, but there's not a certain outcome. Otherwise, we come back to historical cost, where we have something that is certain, but is not relevant under an economic perspective. This is a problem.
Okay. Vincent, any reflections from your side on principally the how question, how to come to fair value? Or you leave it at...
I agree with all the points you've raised, Mario. I think the question also of faithful representation, I think the latter point you just touched on, there'd also be challenges in a historical cost environment. So I guess in the context of pre-financial crisis and way before, there was a challenge with gains trading, whereby there was opportunistic behavior that tended to be in play. So there's a timing issue. There's valuing and there's a timing of recognition. And the upside of fair value is that the timing control is less of an issue, though there could be the upward bias in terms of the measurement itself. But with the historical cost regime, one can play around with the timing. So there are always challenges with faithful representation. So
in that sense, both models, even if you go to historical cost, there could be gaming, and you could play with outdated historical costs that can also lead to results which are not faithful either of the economic performance. So, okay. Having said that, any views on my left-hand side, the other panel members? If not, I suggest perhaps a second question from the audience, and then we go back to also some questions that we had already put forward. Now, this becomes, although I have a logical candidate, 10 people are asking us now, is it useful to consider markets to be efficient when setting standards, or should the starting point be that markets are imperfect? Now, if we go into the academic literature on that, we can probably fill the rest of this afternoon. And it may be a challenge if I ask somebody to summarize it. Janus, would you like to have a stab at it, or do you say this is too philosophical for me to do in 5 minutes?
No, it's not philosophical. I think the answer can be very brief. The starting point should be what the reality is, and the reality is that many markets are imperfect. And we have to deal with that, and I think if markets wouldn't be imperfect, there would be much less need for accounting standards.
Yeah, okay. Also, there would be
good news.
Yeah, there would be much less need for a debate like we have today, exactly, so it would make life at least not as interesting as it is at the present juncture.
Perhaps I should add to Janus's point that the role of the standards is to help with those imperfections, because if we did have those perfect markets, the perfect information, we wouldn't need the accounting standards like we do.
Yeah. So, and again, we wouldn't be sitting here this afternoon to have an interesting debate on that. Perhaps taking it to a slightly different angle and a slightly different also direction is there another aspect, perhaps another viewpoint? We see more and more also interest into areas of non-financial information, of sustainability of business models, and that is perhaps a new area where you could also ask, should that have a place, and which place should it have in valuation and in valuation standards? And maybe, Alain, also from your view, is this an area which perhaps we should receive more or new attention?
Thank you. I would say in principle, yes, and I think there are 2 points in particular that maybe are relevant in the context of a discussion about sustainability. One is the sort of long-term perspective, and the other one is the questions about externalities and should externalities be reflected in prices and so on. If I can start with externalities, I think from a point of view of public policy, you do want externalities to be internalized, right? Because if private actors are not paying prices that reflect the full social costs, then you reach outcomes that are not Pareto efficient, and so you do want that as an ultimate destination. The question is, are valuation and/or accounting standards the right tool to do that? Personally, I'm very skeptical about that, because I think accounting standards need to reflect the prices that are paid in transactions, whether that's fair value or historical cost. Doesn't really matter. That is the purpose of accounting standards, and I don't really see how accounting standards can reflect externalities that are simply not being priced in, which is by definition what an externality means. That doesn't mean that we shouldn't try to seek means to ensure the internalization of these external costs. And maybe valuation standards can also play a role there in terms of providing models that people can use to estimate what those externalities might be and how they might affect prices if they had been internalized. But I think on my position, again, it's a very preliminary position as always, is that I don't think that accounting standards are the right tool to achieve that particular outcome. On the long-term perspective, again, in principle, I think there are questions that can be asked of accounting standards. For example, there's a whole debate about stranded assets. If you have assets very long-lived assets that are impaired because of whatever reason may be, climate change or other reasons, is that actually being picked up? You can ask the question of the standard, but you can also ask the question of how the standard is implemented in practice. I mean, there is a standard in IAS, what is it, 16 or whichever it is, about impairment of long-lived assets. But you can also ask a question: in practice, is that being applied in that way? So I think there are issues that can be relevant from the point of view of setting either valuation or accounting standards. Of course, you have to then make a judgment of whether that is actually going to lead you to a useful outcome. If you are doing a valuation on the basis of a discounted net present value of a very long-lived asset, the valuation, the net present value, is probably going to be much more sensitive to your assumptions about the discount rate than it is to what is going to happen in 30 years. Yeah. So that's just a question then, does it make sense to do it? Right? Is it going to lead to any useful information? Yeah. So I think those are the 2 points that I'd put my finger on.
Okay. Thank you. So in that sense, there is a certain reluctance also to say it's really an immediate need for that.
I wouldn't say reluctance. I would say that these are questions that are on the table, need to be looked at, and I don't think there's any reason not to look at them. But let's see where this takes us.
Okay, Mauro, any views from your side?
I can just add a few thoughts. For sure, sustainability has impact on firm value. The main 3 drivers of value are growth, risk, and profitability. And we know that sustainability increases growth just because improve reputation, and so the capability of the company to attract intellectual capital, reduces risk, in particular idiosyncratic risk, and increase profitability, reducing waste in operation, for example. Okay, and so we know that sustainability is a driver of fair value, but there is also an indirect linkage to value, in the sense that we know that a company with a stronger corporate governance mechanisms usually have more sustainable business model. And we know from literature that corporate governance mechanism is linked to the reliability of fair value measurement. In particular, we know that the discount made by the market on level 3 fair value is lower for company with a stronger corporate governance mechanism. So I think that there is an indirect mechanism that link sustainability to fair value. And this is saying us that sustainability and corporate governance can mitigate information asymmetry in fair value estimates level 3.
You might even put that into an optimistic setting and say, so well-managed companies that are well-governed and are paying attention to sustainability might also be expected to create more value, because they are in essence also managing the resources of the company appropriately and optimally, even if that's...
Yes, generally speaking, yes, and they are able also to attract more capital, and this is another driver of growth. Yeah. So we have literature that, of course, we are at the beginning of this kind of literature, but we have evidence, and strong evidence, that sustainability, capability to attract talent and capital, and corporate governance mechanism are strictly connected.
Okay. Vincent?
Yeah, sure. Yeah. I'll just add, I think there's growing impetus from an investor standpoint for information around the long-term value creation possibilities. But this needs to be viewed in a broad sense. So there's a lot that could be done on the disclosures front. Yeah. And I believe the work that the International Integrated Reporting Council is undertaking is crucially important. For the fair value measurement question, because there's a narrative around the interplay between fair value measurement and incentives around long-term investing. My sense is that there's need for more robust evidence around that. And last week at the IFRS Research Conference, there was a very interesting paper which was presented in the context of pension accounting. Yeah. So studies along those lines and getting a sense of the extent to which incentives to allocate assets differently and to tilt towards a longer-term horizon based on accounting and recognition and measurement requirements would certainly be useful. So I think conclusions are being made around the interrelationship between fair value measurement and long-term investing, but that needs to be evidence-based.
So Vincent was referring to the ISB research conference that was here in Brussels last week, where indeed there were interesting insights also on from academic studies into the interplay between also, again, valuation, the use of fair values, and also investment decision-making in the context of pensions, but you can also take that into other contexts. And it is certainly an area where a lot of work can be done to better understand also the consequences and future consequences of accounting and using those fair values. Okay, having explored that avenue, and I'm also looking a bit around the table, but I think we have the input on that question. We've so far been in a, let's say, although we discussed also the financial crisis, but in a generally positive mode that fair value information is useful. It provides additional transparency. But the question that also can be raised is, can it also have undesired and perhaps unintended consequences? And especially also with respect to financial stability, are there aspects of fair value information and financial reporting that may not have been foreseen and that at least should be taken into account when using that information and also when requiring that information? And of course, if we say financial stability, then that has a very strong also public policy and public interest aspects in it. So, Alain, would you like to kick us off on that question?
Thank you, Peter. First, I'll just say that I completely agree with what Marubini said before about, and that is something that we're working on also. We're also working on in the context of, for example, the new Directive on Non-Financial Information, which is precisely geared towards providing investors and users that kind of information about the sustainability dimension of companies and the corporate governance dimension. But turning back to this question, first of all, I think there is a little bit of a danger in discussing fair value in a sort of generic manner, because fair value can actually mean different things. Fair value through profit and loss is one thing. Fair value through OCI is another thing. A disclosure of fair value is different from a fair value that then feeds into the P&L directly. So we have to maybe be a little bit more precise about what we're talking about when we're talking about fair value. Fair value level 1, level 2, level 3 has been discussed also before. Again, this can have very different implications. I noticed one of the questions on the board was, is level 3 mark to myth, mark to magic, or mark to, I can't remember what the third one was. But somebody was getting very creative about how to interpret level 3. And I think these are genuine questions, right? So we can't ignore them. I think so. David earlier made a very good point about the uncertainty that is sometimes introduced into fair value estimates. And clearly, if you have uncertainty about estimates, you're going to have uncertainty in the market about the reliability of those estimates. And those can flow through then afterwards into prudential measures and so on. And clearly, that dimension of fair value can have a very destabilizing impact on financial stability if it's not managed properly. Few other points that maybe I'd highlight. The link between fair value and business models. I think you have to be careful when applying fair value. There has to be some underlying link, I think, between the measurement basis that you're using and the business model that the company is using. I think that is something that that principle has been recognized in IFRS 9, for example, with the SPPI test and so on. But that's something about which care needs to be taken. The question of the link between fair value and procyclicality, have we maybe overdone that concern? But clearly that concern is still there, and the procyclicality the cyclicality of markets and the impact that accounting can have on that is, I think, still a live question, even if maybe the literature has been a little bit more nuanced today than it might have been, the immediate reaction might have been. And then the question of sudden stops in markets. Yes, there is a provision in, I think it's IFRS 13, about the fact that you should not take into account necessarily fire sale prices. But that then raises all kinds of questions. If you're putting an estimate into your fair valuation and that doesn't actually reflect what the market is doing, what is the behavioral impact of that on the market? And I think that's for example a question which for me is still live. So there are a number of ways in which I can see a link between fair value and financial stability. But I'd put them as questions rather than... I don't pretend, as a mere physicist, to have answers to these things.
Can I just comment
Yeah,
there?
sure.
Of course, one of the issues comes up that the regulators are looking after protecting creditors and accounting standards are focused on investors. So that divergence means that different objectives are there, leading to different responses in terms of measurement.
No, that's clear. And Janus, I see you also nodding.
Yeah, I mean, for regulators, the options are still there. They can use the IFRS income or the IFRS equity as starting point and adjust for whatever their purpose is, and they do that. I mean, in terms of short-termism, I would even take the point around. Of course, I do see the potential problem that fair value accounting gives some incentive to gamble if you can benefit from short-term gains and in the very short term. But on the other hand, especially if we look at the loss side and at loss recognition, we've also seen that the early recognition of fair value losses has a disciplining effect on management. There's some literature, some early literature that compares firms in settings where those losses are not recognized in a timely fashion, at least not going directly into regulatory capital, and firms in settings where, well, this happens. And we see that in those settings where those losses early on reduce regulatory capital, this sends a signal to management to, well, raise additional capital, to cut dividends, to reduce risk-weighted assets. That's exactly what we observe. And so I think that, if we look at the loss side, this, if you want to call that short-termism, that also has some benefits.
Yeah, so that is an excellent introduction, in fact, into the next polling question, because that deals with short-termism, and perhaps if we could get the next polling question on, then we can also have the views of the audience on that. Because the question is straightforward. Do you think that measurement at fair value encourages short-term thinking, short-termism? And again, you have three options. Yes, and the effect should be considered in setting standards. Or yes, but the effect should not be considered in setting standards. Or you don't think that it has an impact. And now, in the previous question, the yes camp was significantly outsizing the no, but now we are more in balanced views. So after 42 people in the audience, we still get some last-minute, and now some important last-minute thoughts in. But I think the stable answer is that nearly half of the audience thinks that it doesn't at least encourage short-term thinking and short-termism. But yeah, I know that. Look now.
Small numbers. Huh?
It was good to give that summary. You see also that during voting you should never have an active poll outstanding because it does impact the votes of people that are still participating. I now start to wonder whether people are voting for the second time, to be honest.
They can't.
But we have seen the views of the audience. Still, Anne, a view from you, standard setting. Should the IASB, or does the IASB, let me put it like that as an open question, consider the impact that standards and the use of fair value in standards could have on short-term thinking?
I think it's fair to say that in the forming of standards, there are a number of views around the table, and we would look at short, medium, long term. We don't. I don't think standard setters specifically create standards that will prevent the opportunism that we've been hearing about, that management can engage in, particularly with fair value measurement. But it's still discussed. It still has to be recognised. So I think my answer to your question is that there's a number of elements that we have to consider to in our objective of creating a standard that's going to produce useful information. There's a number of elements to it. And to think about consequences of the standards, yes, I believe standard setters do that. The paper being referred to about pensions, the idea was that there were unintended consequences of a standard. But to the best they can, standard setters and staff try and examine what the impact will be, and hence the standard setters get engaged with trying out things in practice and talking to people and trying to see how standards will affect things. So I don't think there's a focus on short-termism and a worry about short-termism on its own, but I think there's a great deal of concern about how things will impact into the marketplace.
Yeah, and I think also we have to acknowledge that more and more work is being done also by the board on understanding the impact and assessing the impact up front. And that also, obviously also incorporates various considerations, including this one. Alain, you also wanted to respond.
I'm not going to try to answer the question directly, but if I remember my history correctly, the attitude towards fair value, in particular in the US, sort of has varied over the years, right? And again, if I remember my history correctly, before the crash in 1929, the accounting framework in the US was fair value-like, maybe not what we would call fair value exactly today, but it was something like that. And then after the crash, for 50 years, again, if I remember my history correctly, the SEC didn't want to hear about fair value. And it was only the S&L crisis that relaunched that debate. So that, for me, raises an interesting question. Are accounting standards actually the proverbial thermometer? Is this really a neutral science that objectively measures something that we're interested in finding out about? Or are accounting standards a lot more contextual? And when we talk about fair value, for example, I don't think there is such a thing as the fair value. There's fair value with respect to a specific accounting framework, right? And what fair value you're trying to obtain, I think ultimately depends perhaps on social considerations, public policy considerations, and therefore what is the relevant accounting standard perhaps can also be driven by social or political considerations. I know this is something that might horrify, in particular, standard setters. But and I think that is germane to the debate about short-termism. Because if accounting standards do have behavioral impacts and can drive short-termism, and I'm putting this as an if, then it would be legitimate to ask the question whether we should not look at these broader public policy considerations in that context.
True. We will not go into the US history on the use of fair value, but I think it is depending on the context, and thereby also you have to be cognizant of the social consequences that standard setting may have. And those who say that it's neutral and only a technical exercise, they also are probably looking at a narrow scope of the world, and the world is wider than only the technical accounting quality, which is also important in standard setting, by the way. You might even go as far as saying, relevance, it is different purposes for which you can use fair value, and you should be very conscious of the purposes for which you want to use it and whether it's suitable for that purpose. Okay, I suggest that we take it to a question that was also already briefly raised prior to that. We had the polling question, and that is estimation uncertainty and how it affects the usefulness of fair value information. We have already touched on that a few times because there is a balance between relevance and reliability to some extent. Vincent, any further thoughts on how exact financial fair value information need to be?
I think we've covered a lot of ground on that, but I would just emphasize that I think the point Professor Bini mentioned, the interplay between auditability, recognition and measurement, and the required disclosures, that's really crucial. The real issue around fair value is around, at least for me, what I deem to be peculiar to fair value measurement is the inherent measurement uncertainty. And that's quite clear when you look at the level of audit regulatory deficiencies, which tend to be quite high around fair value measurement. And also, some studies have been done which show that, for example, when you look at financial instruments, a sample was looked at, and nearly 40% of that sample, when you looked at the measurement uncertainty, they would be at factors that would be greater than 2 times materiality. And it can get quite high. I know during the crisis, there were cases whereby if you looked at the volatility of level 3 assets for some banks, it could be as high as 50 times materiality. Now, is that kind of information auditable? That's the question. And clearly there's a role for not just the accounting standard setters, but the auditing standard setters as well, to ensure that the tools and techniques and the mindset of auditors gets up to the place whereby they're better placed to audit this type of fair values. But that's some way to go. And disclosures become critical in terms of conveying to users of financial statements the inherent measurement uncertainty. But I think, as Anne mentioned earlier on, there are various disclosures that are currently required. Some are more useful than others. So I guess the hierarchy of fair value disclosures are quite useful. It's important to have the appropriate aggregation of assets and liabilities in the disclosures that are provided. Sensitivity analysis, which would inform on inherent measurement uncertainty. I guess the jury is out in as far as getting to the place whereby that's fit for purpose. But from my point of view, I see it as a very important disclosure because we're in a place whereby I really can't, or auditors can't give meaningful assurance around the numbers that are provided, or at least there's a differential in the nature of the assurance that's being provided. So disclosures really become critical for users to have an appreciation of the measurement uncertainty. And Professor Benny mentioned the discount that's applied across the hierarchy. But that discount, again, is it a rational discount? Is it one related to information opacity? Is it related to illiquidity? Questions revolve around that. So I think disclosures are really critical to address the measurement uncertainty questions.
Okay, thank you for that. And I also hear you say perhaps the missing party on this table also is the auditors, because also there, and I even hear you say perhaps also a more informative view of the auditor on the various levels of reliability of that fair value information could help to better make the risk understandable and to better judge also the value of that information. That's
Indeed.
Okay. But we can't invite an auditor to bring us views unless somebody in the audit wants to stand up. But maybe also then still, Janus, an academic perspective.
Yeah, I think my perspective is very much in line with what Vincent just said. The estimation uncertainty in the end just reflects the uncertainty of the economic underlying. So we'll really be better off if we just had cost information available, not necessarily, at least not in terms of predicting future income or future performance, which is like the very purpose of IFRS accounting. I think the problem is not so much how to deal with that uncertainty from the user's perspective. It's more like that this uncertainty, well, leaves management with some opportunity for discretion. And I mean, that could be exploited at least in the absence of appropriate risk management, of appropriate enforcement. And that's, I think, something that's important to be established.
Okay, thank you. Now, we are sitting here together to also discuss cooperation, or at least or interrelation between accounting standards and valuation standards, and the working together of the standard setters in those two arenas, so the IASB and the valuation experts. And yeah, the question that can come up, there are, as already David Tweedy showed, there are contacts, there is coordination between the work. Is that enough? Should it be more? What's your view on?
Oh, I think there will be more into the future. There is the interaction now already, and of course we're aware of this. If we think about financial reporting for extractive industries, people, oil and gas, we know that there are some very important disclosures around the valuation of the resources and the reserves, and they are not based on accounting standards, and they are done by valuation experts. So it's a stock exchange listing requirement in some jurisdictions that the JORC code is followed, and the JORC code professional valuers are valuing those resources and reserves. So that's something in place, and that's an interaction between accounting standards and the work of valuers. And I think that model will continue if we think of the way that accounting standards provides a framework or provides principles, concepts, ideas of how recognition and measurement can happen, but those same standards don't specify the techniques that people will use. If we think about IFRS 2, and we can see that the Black and Scholes model came from economics and led a whole development in option pricing, and then those techniques that are now available through that development can then be used when people are pricing their options in IFRS 2. But it's certainly not, those option pricing models are not being specified within a share-based payment standard like IFRS 2.
Okay, thank you for that. And Mauro, from your perspective?
I have to say that to me the distinction of roles is quite clear, in the sense that accountants has to say what to measure at fair value, valuers has to say how to measure the fair value, and again auditors has to say how much detail in valuation must be followed for an auditable fair value. The problem is not just for standards. I have to say that accountant is a profession, but I have to say that valuation is far west. Okay, so we need to transform valuation in a profession around the world. This is very important. Because a profession is something, and Sir Tweedy raised the point before, a profession needs not just valuation standard, but also professional standard, of course, and performance standard. And all these elements must be considered in a good valuation and in evaluation for financial reporting. So I think that the major efforts will be in this direction, and IVSC is making a lot in this direction. And I think that all the regulators know that this is a very important critical point in adoption of fair value accounting. And I think that presumably we need to make an effort in order to raise this awareness at the level of users of financial reporting, because otherwise the idea that fair value accounting has the same quality using different valuers, this is not true. I want just to tell our experience as OIV. OIV is the Italian valuation standard setter. We were created in 2011. Few months after our creation, our Financial Security Authority asked for a document about impairment testing in financial crisis. Why? Because the majority of Italian listed companies after financial crisis didn't register any impairment loss. Okay, and with our document that was issued at the beginning of 2012, just with adoption from our consob of a comply or explain mechanism, we had more than 20 billion impairment losses for our listed companies. This is an example that if you have best practices to follow everyone has to follow these best practices, and it's very easy to enforce the accounting standards. So I think that accounting standards, of course, must be at a high level, but we need to cover the enforcement of these standards just as a profession, so as valuer, as regulators, and developing best practices. I think this is the ingredients for a good fair value accounting.
Thank you very much for that. Now, I'm realizing the time, and we have agreed that we will give all the panel members a last minute to give their final reflection on fair value. Before doing that, I think also to do some judgment to the audience, we can take one or more or two questions from the audience, if we can get them up quickly. At least the questions are not, there are sufficient questions. The one that has 8 people asking it is if level 1 is marked to model. Oh, that's the question. If level 2 is marked to model, what is your preferred definition of level 3? Marked to myth, marked to magic, or marked to mood? Well, that may be a bit of a nice way to finish it off then, and then I'll ask all the members of the panel simply to state their preference, and then you can have your minute to give your final views. But how do we rate level 3? Alain, you were looking for the definition, so now is your pick.
No, I couldn't remember what the third one was, which was marked to mood. But, it's very creative.
Yeah. But any preference?
I don't know. I think the underlying question for me is still the one about uncertainty. Yeah. So David, earlier, when he was talking about intangibles, highlighted the fact that one of the great barriers towards recognizing intangibles on the balance sheet is the uncertainty in measurements, right? Yeah. And if you can't state a number with any degree of certainty or precision, then it's not really a number that should be on the balance sheet. Yeah. And I think you could raise the same question about level 3, perhaps.
Yeah. I think, again, it is the balancing between relevance and reliability to quite some extent. And the farther you go towards level 3, that balancing act becomes more and more complex, and the uncertainty increases, and that makes it judgmental. And I think that's the bottom line of that comment. But then why don't we also wrap it up? I would, and I'm conscious how, or at least wondering now how to pick a sequence, because everybody has its final reflection. Yeah, and then I have to be polite, Anne, and start with you. And then I'll just go round the round. Anne.
Okay, I think I heard you said, Peter, that we're going to give our opinion on, level 3, or what we think, or what we like. Or look, I just call on everyone: keep giving us, the IASB, keep giving us your feedback, because we're standard setting into an environment, and we need the feedback, and we collect that through post-implementation reviews and through our discussion papers and EDs and so forth. So just keep giving us your feedback, because the IASB modifies its position according to what can be accommodated in our various communities. So in that way, I think it does reflect what Alain says, that it's a social construct we're dealing with in accounting, and we're not going to get perfection, and we're just not going to get perfection, but we will certainly be responsive to people's views, and standard setting is always within a cost-benefit trade-off. Okay. So keep talking to us.
Thank you for that. Alain, a final reflection?
No, I think the trap that we can fall into when discussing fair value is to get into a very sort of almost theological debate, right? And is fair value intrinsically good or intrinsically bad? And I think it's the reality is that our accounting framework is based on a mixed measurement model, and you have to look at things in a very specific way to really be able to answer that question. I don't think there is a single answer to is fair value good or is fair value bad. I think the abuse of fair value can be bad, but then there are lots of people, including many people today, who've also highlighted the fact that the abuse of cost accounting can perhaps also be bad in certain circumstances. And I think you just have to look at the specifics and try not to get dragged into a sort of theological debate about fair value.
Okay, thank you for that. Jens?
Yeah, it depends on the quality of the related disclosures. It depends on the quality of the enforcement system. And there are a lot of ifs before you can finally answer the question whether fair value is overall beneficial or not. Will remain an interesting academic debate.
Okay. We look forward to that continued debate.
Just to say that I think that under fair value there is a cultural issue. I remember that, for example, for impairment testing, for many managers, an impairment loss was a shame. Okay, just because they didn't understand the idea of impairment testing and what impairment testing is. So something similar there is in fair value. We have a literature that is saying us that fair value is economic relevant, and this is the starting point for any debate about fair value accounting. Of course, we can do many adjustments, in particular from the point of view of disclosure. More disclosure, presumably, are able to solve many problems of fair value accounting. Just because with more disclosure, we have to consider also that the preparers learn by other preparers. And we could have more culture about the implementation of fair value also in difficult contexts.
Thank you for that.
I just, the point Alan, I think, mentioned, views around fair value have tended to ebb and flow, and it's evolved over time, depending on economic cycles. So I can understand the notion of there being a theological component to the discussions. But I think what the IVSC is bringing to the table is very important. And that was really highlighted in Sir David's presentation. There's the whole art of valuation, the art and science of valuation, which needs to be enhanced from the standpoint of both comparability, improving the consistency around the valuations that are reported. But I think there's also a possibility to look in areas where there's heavy measurement uncertainty, so intangible assets. So to what extent can we get to a point further down the road whereby the art of valuation may reduce the concerns that exist around the measurement of intangible assets. Yeah. And that in turn could enhance, I'm not saying you need to recognize those on the balance sheet, but even from a disclosure standpoint, you could get to a place whereby you'd have better information available for a broader set of assets and liabilities. So I think the coordination between the IVSC and the accounting reporting framework is really critical.
Yeah. Yeah. Okay. Thank you for that, Vincent, and that was nearly already a closing statement. I'm not going to give my own views, but also thinking about a final comment, I was intrigued by a quote that is also illustrating that this line of thinking is not really new. In 1936, John Hicks wrote in Value and Capital, "Wealth is determined with reference to current market values of net productive assets at the beginning and the end of the period." So that's a comprehensive model of measuring income. He had one caveat there, and he said, "This only holds when wealth can be measured reliably." So perhaps that is a good thought also to take us to coffee. Thank you for your attention. Thank you to the members of the panel for their valuable contribution, and we look forward to continuing this debate. Thank you. Thank you.